welcome back to the course Introduction to Commercial Banking and Fintech, and in this particular course we are discussing about monetary policy transmission, the balance sheet analysis, how we are understanding or doing the balance sheet analysis. So monetary policy transmission basically talks about different dimensions. So in the last session we were discussing about the cash flow channel and how the firm vulnerability can be decided based on the covenants, the debt capacity and headroom, and how these small topics are very important. And we also looked at that with the rate of change decrease from 10 to 7%, how we are seeing the increase in overall output in the economy and what is the positive impact of investment. So this is what we covered in the last class. In this particular session we will be touching upon a related but interesting dimension, that what happens with different scenarios of a small rate of interest cut. So this is what we are trying to touch upon. So we covered this in the last class. Okay, so this is what we are touching upon. Sensitivity scenario, a smaller rate cut. So for example, we consider a situation wherein or scenario we are seeing that a moderate monetary easing in which lending rate on variable rate debt declines by only 1 percentage point. The effect on interest expense and covenant compliance is weaker compared to a larger cut. So this is what is so suppose debt stock is the initial is 500 crore, EBIT is 90 crore, interest cap is 50 crore, and rate of change is just, it increases just by 1%. Earlier it was 7%, now we are just reducing it by 9%. Then how it happens? So suppose interest burden, so here we have at 10% we have 50 crore, at 9% we have 45 crore. How much is the extra headroom that you are getting? So it is 5 crore that you are having, right? How much is the interest coverage ratio on the new? So we are getting 2, right? If you have a smaller cut, we are able to see that firm is just meeting the covenants, right? So it improves the compliance of the firm, but the improvement is marginal, it is not helping that much. What is the purpose? So headroom under this, what is going to be? So 50 minus 45, it is going to be 5 crore only. So this is what it implies. And debt capacity, how much we have the additional debt? So additional debt that we are having, so 50 minus 45 is the 5 that here we have. At what rate of interest? At 9 rate of interest. So how much we are seeing? So additional debt you can borrow is around 55.6 crore. So you can see that with the 1% rate cut, you can see how sensitive is the investment in the economy. So when we read newspaper and when we try to understand the overall interest investment scenario, and in the ISLM framework we looked at I is equal to I bar minus BI. Now we are seeing that when the rate of interest cut is lower, then we have a very marginal increase in the financial health of the firm, but it is good that it is able to meet the compliance, but the impact is marginal. But when we are seeing a drastic rate of interest cut, we are seeing a multiplier effect of 428 crore. This is what is the crux here. So 1% decline, it increases the borrowing capacity of the firm by 55.6 crore, much smaller than in the larger cut scenario. So this is what here we have. A smaller monetary policy cut yields limited improvements in interest coverage and borrowing headroom, implying that weaker transmission through the bank rate channel, and this is what we have. So if you have the rate of interest cut is lower, then here you have the lower multiplier effect, you can say, because borrowing capacity of the firm goes up, right? So this is what it implies here. So with this, I hope we are able to understand the capacity, because if the rate of interest is lower, you can think about the increasing scenario. The cost, if the firm cost goes by 11%, then you can see that things will change and the cost will go up by this amount, and this is what is the understanding here. Now we are moving to a new setup where we are talking about the prices. So when the rate of interest is lower, inflation goes up. What is the channel here? So when rate of interest goes up, it implies that money supply has gone up. This will shoot up the prices, right? And we can also see unexpected component we can add, right? When the unexpected component has gone up, your overall debt value will come down because price has, so real debt value will come down, right. So so if you are borrower you gain, if you are lender you lose, right. So your real wealth goes up, lending goes up, as a result your investment go up and your aggregate demand will shoot up, right. Now here the lending that you are seeing, it may not be because of this reason, because you hardly notice this, it will be directly linked with this, right, because and this is again linked with this and this linked with this. So this is the channel that we get here. These things are assumed. If you are rational investor, rational lender, then only you can foresee these things, otherwise normally people don't care about, right. So wealth increase real is how much you have, how much is the asset real and how much you get the real in terms of debt. So if you have a P higher you get the real rate lower and this will increase the wealth, right. So this is what here we have. So asset measured in base year, nominal debt is fixed in dollar and prices, and P1 is this is what we get in terms of previous period inflation. So 1 plus R you can see, right, and real leverage you can see once I have the real debt upon the asset layer. So this is what it implies. If this is higher than this, then overall ratio will be lower, and this you can work out with denominator and numerator, right. So let's have the example, inflation and real leverage. What is the case that we are looking at? So here we have, consider a firm with a nominal debt and real assets. So suppose nominal debt means at current prices is 500 crore, real asset base value is 800 crore. Suppose base value we can consider last 5-year prices, so maybe 2015 prices or 2020 prices, whatever the government decided base year that we have. Initial price level suppose normalized is 1, right. So we just consider that it is 1 numerator kind of price. Unexpected inflation we are assuming that it is 10%. New price level, so 1 plus 0.10, so 1.10 is the price new price that we are going to see. So unexpected inflation is this. Now the question is, what is the real value of debt before and after the inflation surprise? So this is what we get. What is the real loan to value ratio before and after shock? By how much does the real leverage fall? So this is what it implies here. So real debt before shock is this. So 500 upon 1. Now the price has gone up, so you can see it is having only 454.5, right. So this means that your debt, real debt value comes down, right, because you have the price increasing. Now but if the price is lower, your real debt value will go up. So what is the meaning? So unexpected inflation reduces the real burden of nominal liability. So earlier you had the 500 crore, but because of the price increase now you have the liability of only 54 crore. So that's why it is normally said that when you have inflation higher and if you are lender, you lose money in terms of real, you lose in terms of real terms, right. And if you are borrower with high interest scenario or high inflation environment, then you are a gainer because your nominal liability is going to come down as the price increases, right. So this is what here we have. So in terms of debt real in period 1 with updated 10% inflation, it is going to be 454 crore, right. So this is what we get. Real LTV and the leverage adjustment. So this is what here we have. So loan to value ratio, this we get. So in period 0 it is coming out to be 0.625. This is what here we have. After shock of 10%, so it is, we calculated 454 here, right. He calculated 454, so it is coming out to be 0.56 only, right. So 56.8%. So change in the real, so you can just subtract, so 0.568 minus 0.62, so you have declined by 5.7%, right. So an anticipated 10% inflation shock reduces real leverage by about 5.7 percentage points, relaxing collateral and borrowing requirement. It means that if you have collated your home or any kind of fixed deposit, so this will be adding this, right, 5.7 percentage point. Balance sheet effect of unexpected inflation. So with fixed nominal debt, your surprise inflation reduces the real debt burden, raising a real net worth of lowering leverage for borrowers. So here we have T is equal to 0. So here we have asset real is equal to 150 crore, nominal debt is 100 crore and price 0 is 100. Expected inflation is 2%. It gives the price in period 1 102, and actual pi is 10% and it gives price 110. So this we have already noticed, right. Suppose expected inflation is 2, so it is 2%. When it is 10%, then it is 110. We have done. The question is that compute real liabilities D upon P1E and D upon P1 corresponding to real net worth, which is real net worth is nothing but asset real minus the real debt. So and compute the change in the wealth and compute the real leverage. Real leverage is what to loan to value that you get, right. So what is the rationale here? If P1 is greater than P1E, borrower gains, liability decreases, right. Lenders lose and collateral constraints also relax due to lower leverage. So this is what it implies. Let's work out. So how much is the real liabilities? So we are seeing that D upon P1, so 2%, so it is 98.04. In terms of the actual, it is 10%, so it is 90.91. How much we are seeing the real wealth? So real wealth we are seeing 150 minus 98.04. So here we are having 51.6, here having 59.9, right. So this is good. And in terms of wealth change, how much we are seeing? So 59.09 minus 51.096, so it is coming out to be 7.13 crore. So this is what here we have. Real leverage is how much? Real leverage is 98.04 upon 150. So it is coming out to be 65.4%. If we have the loan to value actual, so it is coming out to be 90 upon, so this we have done already, so it is coming out to be 60.6%. How much we are seeing the decline? So 60.4 minus 60.6, it is coming out to be declined by 4.8, or you can just 60.6 minus 65 you can do. So this we are getting at 4.8 decline, which means that unexpected inflation that here we have reduces the real value of nominal debt, raises real net worth because you will be getting more benefit, and lowers the real leverage, and then your collateral value will not be required that much. And this is one of the beauties of this particular example that I have given. Now let's move to the deflation. With fixed nominal debt, deflation raises the real debt burden and reduces borrowing net worth, worsening leverage. So this is what we are expecting. Suppose given at time t0, your asset real is 150 crore and nominal debt is rupees 100 crore and price is 100, right, initially. At t1 is 2%, and since we are talking about deflation, so price we are assuming that is coming down, so it is 5%. So now it will be 95. Now compute under actual deflation. So this you have to think about the real debt, then here you have to think about net worth and LTV you have to calculate. Compared to the expected case, when we had the expected inflation was 102. So this is what expected inflation. How much we are seeing in terms of net worth and how much we are seeing in terms of delta loan to value. So this is what it implies here, right. So this is what here we have. So unexpected deflation is how much? D upon P1 is nothing but 105.26. Real net worth is how much? It is 44.74. So this is what we have. Compared to expected case is how much? It is nothing but 44.74 minus 51.96. It is coming out to be a decline by 7.22, right. And if you think in terms of the actual, so it is coming out to be it is 150. So 105.26 upon 150 that we have already assumed here, it is coming out to be 72%, which means that 400 point from the, so we are seeing here how much? It is 65.4 we had, here we are having 70.2%. So if we just subtract that, it is coming out to be 4.8, and which means that deflation raises the real debt, because if you have price denominator lower, if this is lower, your overall real liability will go up. If this is higher, then overall real liability will, and these examples are just to have you understanding, which means that lender, when the inflation is lower, it gets, borrower gets when the interest rate is higher, then the collateral value will have better capacity, because your nominal in terms of real liabilities you see a increment, but it also leads to you can say higher borrowing capacity. So this is what it implies. Here in this example we have something called partial asset repricing. What does it means? Not all assets adjust to inflation at the same speed. A share may be nominally fixed, which means that you are having cash, inventories or all, while the rest reprice at with the price level, right? So if we are going for partial asset repricing with some kind of stickiness or rigidity that we assume, this affects how inflation changes real net worth. So A0 real is rupees 150, D debt nominally is 100, price 0 is 100, expected price is 10%, so P1 is 110, right? So this is what here we are. So in this we are saying that 30% is nominally fixed, right? So this could be like given the, for example, you have cash so instead of you have borrowed money, but you have promised that you will be giving this much of the in the form of stock or some kind of goods that you have, and the lender has agreed that okay, I am paying you 1 lakh rupees, but you don't have to pay 1 lakh rupees, only pay 70%, 30% I will make adjustment with different things. So this is what it implies, asset stickiness, right? So nominally fixed, so which means that only 70% you allow to reprice, right? Because those 30% will depend upon other factors, right? The stock price up or down or anything. So compute post inflation real asset. So this is what here we get. So A1 real is equal to A0 real, and then here we have the constant which is related with the price ratio, and then we also go for the rigidity that here is stickiness, right? Now real net worth is how much? W1 real is equal to A1 real. So we have to calculate the real, and then we have to also see with respect to example 1, when we had the full repricing, how was net worth changing, and the learning is that how it surprises the overall inflation. So this is what it implies here. Solution here if you just think about, so normally fixed share is the and real value of this. So if I just put this into number, so 150 I have the A0 real, 0.3 is the stickiness that here we have, 1 minus 0.3 is 0.7, and this is what here the 110% surprise inflation. So it is coming out to be rupees 145.91. Now in terms of real liabilities that we have assumed, this is what is the example 1 that here we have. Now in terms of the real net worth, what we are seeing that we are having the increase by rupees 55, right? So if you remember, real net worth was 59.9 in example 1. So this is what here we have the example 1. And asset stickiness, you can see it comes down again. So this is what it implies. So which means that if you are lender, you are going to see the decline in your, if you have the asset stickiness, then it basically, if you are a borrower, then as a borrower it basically does not help, it basically reduces the chances, right? So delta W is equal to what? 55 minus 59.9, so it is almost rupees 4.09 versus the fully real asset. So this is what it implies here. Now another topic that we want to touch upon. So here in this case we are seeing that stickiness does not allow you to pass on the benefits. So your real net worth will not have that much improvement. It will have, again it will come down. So this guide is coming down by 4.09. Now we are seeing that how we can see the pass on benefit in a much simpler way. So in the modern world we have also something called indexed versus fixed. What is indexed? So how much you have the inflation indexed kind of asset being really I would say preserved. So what is the indexation? Indexation is that how it is linked with the cash flow. It goes into that a portion, for example in the index linked bond, your principal will be attached with the, your coupon will be fixed, but principal will be attached with the inflation. So this is what it implies. So here you can see where the principal is so indexation is basically a linked to the cash flow of a contract, like wages, pensions. Whenever we see increase in prices, we see revision in the wages of the individual, salaries, bonds, loans. And how, what is the reference? Reference is, it is with respect to CPI or WTI. What is the objective? To keep the real value of the payments broadly stable by automatically adjusting for the inflation. For borrowers lender, it separates real return from the inflation compensation. So this is what implies. In India, we have inflation indexed government securities. It was long back. And what is the feature of this particular IIGS? That your principal is periodically adjusted with CPI, but your coupon and other rate is fixed in percentage term, and it is paid on inflation adjusted principal, which means that your principal also gets increased. So even if the coupon rate is fixed at 5%, earlier you were getting at 1 lakh, but now you are getting at 1,10,000, right? So this is what it implies. Investors are protected against unexpected inflation, and this indexation is helping. So indexation can be given on any type of asset that you have. Basically we are trying to give investors the benefit, because in bond you will have the same fixed amount with appreciation, and then you have the rate of interest. This comes as an extra. So this is what it implies. So some debt contracts are fixed nominal, while others are inflation indexed, right? Debt composition affect how inflation redistributes wealth. So this you can see. So nominal debt is ₹100, asset real is 150, price at 0 is 100, inflation is 10%, so it is next period inflation is the 110. Debt composition, the fixed nominal share is 0.8, so this is what here we have. So 1 minus S is 0.20. So index share, so 0.20 is indexed, 80% is fixed, right? So this is what here. So if you have like 100,000 invested, so it means that 80,000 you have fixed and 20% here you have indexed, right? So 20,000 index, right? So this is what here we have. Now compute D1 real and also the W1 real and loan to value 1, right? This is what it implies. And compare outcomes with all fixed debt. So this is what, and how we can compare with the first. So here if we go for solving, so here we have S is 0.8 as fixed, 0.2 as indexed. So if we just solve this, we are coming out to be around 92.73. How much is the real wealth change? So you can see it is changing by 57.27. How much is the real leverage changing? So it is changing by 61.8%, right? So this is what it implies with respect to the example 1 that I have, right? So if I am comparing, so all fixed real net worth that we saw was 59. Mixed debt real net worth is coming out to 57.27. All fixed loan to value, it is coming out to be 60.6. Mixed debt 61.8, which means that when we have inflation, basically inflation, what it helps, that it reduces the burden of the nominal debt and borrower gains, and this has a lot of impact on the borrowing and other things, right? So this is what it implies. But inflation does not reduce the real burden of the indexed debt, no gain on that portion, because you can see here how much you are having, almost like you are touching the same 57.27, right? So this is what it implies here. So mixed debt real net worth is 57.27, right? And with mixed debt, you can see that the gains from inflation is also diluted, and this is one of the important learnings, that it helps the lenders, but it doesn't help much to the borrower, right? So this is what is the learning here in this case, right? Now here we have also one more example. I think this we can just see that whether it is helping us. So here we have a reduction in the real leverage improves borrower balance sheets. It can reduce the spread that banks charge over the risk-free rate. Lower loan rate stimulates investment through the multiplier and raises aggregate demand. So suppose this is the credit pricing rule here we have. So loan rate is RL, risk-free rate, plus it is the leverage sensitivity that we see, that the gamma that here we have. So if RF is 8% and the operator value sensitivity coefficient is 0.5, which means that the interpretation of this is that a 1% decline in LTV loan rate by it goes down by 0.5 percentage point. So if I am going to see the loan to value expected, it was 0.654 and it was actual 0.607. So how much we are seeing the delta increase? So here we are seeing that we saw around rupees 20 crore per 1 percentage point, and if suppose we have the investment multiplier K is equal to 2, if this is what we are assuming, can we compute delta RL, this RL with the change in LTV, and compute delta I and aggregate demand. So if you have been given this, like how much you have from loan to value to loan rate and output, how much it is. So this is about the macro scenario, that given the risk-free rate of 8%, this is the gamma of 0.5, expected loan to value is 0.64, actually 0.60. Suppose beta we are assuming rupees 20 crore per 1 percentage point change. Multiplier is K, how much we are seeing in the change in output. So this we can see easily. Delta LV it will be 0.048 and delta RL will be what? So 0.5 into 0.048, it is coming out to be 0.024, which means that 2.4% decline. So this corresponds to around how much? So delta RL, which means the loan interest rate on the loan, will come down by 2.4 percentage point. Investment response will be what? Minus 20 into minus 2.4, it is coming out to be 48 crore, and we know that K is equal to 2, so you will have the output response by 96 crore. What is the learning here? Learning here is that with the rate of loan, which is just the parameter change, so given this, the expected loan to value and loan to value of actual, what is the difference that we get? On this difference, whatever is the gamma parameter that we are applying on the delta LTV, it is coming out to be 0.024, which means that it is having almost minus 2.4% decline. Minus 2.4% decline is how much it is increasing your investment. It is increasing by 48 crore, and this leads to increase in the aggregate output of 96 crore. So I hope with this you are able to understand some of the nuances of this. So transmission channel is how much? So this will be the last slide. So with the expected inflation going up, we see that real burden comes down, loan to value also come down, loan rate also comes down, and then here we have real loan rate will also come down, and this will have the expected investment will go up and aggregate demand will shoot up, right? Which means that lower real leverage signals a stronger borrower balance sheet. Banks require a smaller credit spread and it reduces the loan rate, and cheaper borrowing further stimulates investment, it leads to increase in output. So this is what is the balance sheet channel. So the lecture 24, 25 and 26 that we covered today, it basically talked about the balance sheet channel of the monetary policy. In the next session we will be touching upon the different one more channel we are missing with the prices and the other interest rate channel, so that we will be touching upon. And with this I hope you have been able to understand. I will be starting from here in the next session, so that we will have the some quick recap and also try to understand the different aspect. With this I am stopping it here. Thank you so much. I hope you are enjoying the course. Please feel free to write any questions if you have. I have already given the email ID and you can approach me for any query. Thank you. Thanks a lot. I appreciate.